TLTRO, as you know, it has provided ample liquidity at very attractive rates, and it has really been an incentives for banks to continue lending. And in the bank survey that we conduct on a regular basis, they are always indicating that TLTRO and TLTRO special conditions have been very effective in supporting the financing of the economies at enterprise and household levels. You know, clearly, as planned, and given the financing conditions that are available, we currently expect that the special conditions applicable under TLTRO III will end in June 2022. And this is really based on the currently favorable assessment of banks' funding and liquidity conditions and the smooth banks-based transmission of our monetary policy. Now, this does not mean that the support transmitted through the TLTRO III will end, because banks are going to continue to benefit from the attractive TLTRO III conditions. The first operation, if you remember, will only mature in September of 22, and the final one will mature in December 24. So banks are going to continue to benefit from those attractive conditions unless they decide to elect for an early repayment, but otherwise it will continue to be available. And we will remain very attentive, and we will monitor very carefully those favorable financing conditions going forward in order to make sure that our monetary policy is transmitted properly throughout the banking system. On the, you had another one that had to do with
PEP reinvestment in 2020.
Oh, yeah. Well, if you look at this section concerning PEP, we say extend the reinvestment by at least 1 year until 24. And this has been considered as appropriate under current circumstances in order to gain flexibility and in order to attain our 2% target over the medium term. So this is, as I said, at least until 2024. We don't see a need to provide for something longer at this point in time, but as I said, flexibility optionalities are on the table because we need to be attentive to the situation that is plagued with uncertainty, but that is a strong recovery with those good numbers that we are seeing on growth, that we're seeing on employment, and that we are seeing by the account of our targets on the inflation front. With that, I would like to wish all of you a happy holiday, Merry Christmas for those who celebrate Christmas, and we look forward to seeing you again in the new year. And in the meantime, as is often said, but I mean it, given the proximity of what COVID can do, stay safe, be attentive to your loved ones, and make sure that you stay away from this nasty COVID and various variants. Thank you.
We've been listening to Christine Lagarde, ECB president, give a press conference after a decision not to raise rates, to keep rates where they were. They are going to be doubling the pace of their pandemic-era purchases, and then they will follow that with tapering, with the plan to phase it out in March, with the possibility to reinstate it should it be necessary. We will get into some of the important calls from New York City for viewers worldwide. I'm Lisa Abramowitz in for Jonathan Farrow. The U.S. markets just opened, and what's fascinating to me is that despite the hawkish tone that we saw from the Federal Reserve yesterday, despite the fact that we got a surprise Bank of England rate hike today, it is still very much risk on. S&P at record highs. You're seeing a similar kind of activity overseas, with even the FTSE turning upward about 1.4%, and stocks broadly in Europe doing well. Again, this really highlights the strange aspects of this week, that we got what we thought we would get: hawkish tone out of the Federal Reserve, a more dovish tone from the ECB. Markets are shrugging it off, and frankly, the divergence between the two seems to be absolutely counted out, with the euro gaining today. ECB President Christine Lagarde was weighing in on the path of rate hikes going forward, and here's what she had to say.
Under the present circumstances, as I have said before, it is very unlikely that we will raise interest rates in the year 2022. That still stands.
Joining us now is Bloomberg's Guy Johnson. Guy, what did you make of both her very dovish rhetoric, and yet you saw bonds kind of sell off, and it seemed as though we had the opposite reaction in markets?
I'm not sure it was that dovish, actually, relative to expectations, Lisa. I think it was probably at the margin slightly more hawkish, and there's a bunch of reasons for that. The first one is the pickup in the inflation target from the staff projections next year, up to 3.2. That's a really big jump forward, and she did highlight the fact that there could be an upside risk to that number. So that's number one. The second one is that as we transition from PEP to APP, the APP number is not as high as some people had anticipated. We go from 20 to 40, then we'll kind of scale it down 40, 30, 20, and then wrap it up before rate hikes come in. But some were anticipating that that initial number could be as high as 50. So the 40 is a little bit lower than that. You take a look at the opening statement. Transitory was removed from that statement. Maybe the ECB, like the Fed, has retired that number. She pushed back on the idea that there was going to be any rate hikes next year. I just checked. Market pricing is still 8 basis points for a hike next year. Now, we have to get to around 10, I think, for the market to be able to say convincingly we are pricing in a rate hike for next year. But the market is still skeptical about what is happening at the ECB, and that certainly is represented in pricing. Economists don't see a rate hike coming till 2023, but the market can't make up its mind right now, Lisa. So I think on balance, at the margin, slightly more hawkish than anticipated.
Guy, thank you so much for that. Joining us now to parse through all of this Fed, ECB, and Bank of England speak is Alessio De Longis of Invesco Investment Solutions and Flowbank's Tqqq. I am curious, Alessio, from your perspective, whether we got any surprises that sort of edify what we're seeing in markets. Risk on yields a little bit higher in the Euro region, and in the U.S., complete stability in bonds.
We are getting a very interesting confirmation of an alternative narrative that was in place, and I think is the right narrative. We don't have an inflation psychology in the economy. The reason why, in response to hawkish surprises and more expected tightening, we're seeing a risk-on environment, in my opinion, is a confirmation that high inflation was actually causing demand destruction and loss of consumer confidence rather than an inflation psychology towards more front-loaded spending. When you look at consumer surveys, especially in the US, you can see that consumers had lost a lot of confidence, had reduced dramatically their planned purchases of durable goods and vehicles, and the number one cause of that was high prices. So if policymakers are now tackling short-term inflation dynamics more credibly, that is boosting up consumer confidence and is likely to actually improve growth projections. This is how I rationalize the risk-on environment that we're seeing.
That's fascinating. Esty, do you agree that basically the markets are saying, thank goodness you finally are getting on the case, try to curb some of this inflation, that'll be the most bullish thing for growth going forward?
I think that's part of it, this view that the Fed is not asleep at the wheel, that they understand that inflation is a concern for consumers, that it is starting to have an impact, and they just have to open up their options and show they're looking at it. I think the other side is the Fed had done a very good job at preparing us for this type of hawkish tilt, if we can call it that, and it was just not worse than feared. It was one thing we had to get through. It wasn't worse than expected. It wasn't more hawkish than what they told us. The tapering acceleration was basically expected. The 3 hikes in the dot plots wasn't as big a surprise. And again, the majority wasn't in the 3, but in the 2, which again is okay. So the market had a correction a couple of weeks ago, really wants to end the year strong after such a strong year. And I feel like it's also a little bit checking off the big events from its list so that it can move forward.
And that everyone can go on vacation. Meanwhile, it looks like checking off the boxes means more U.S. equities gaining, and that's what we're seeing with building on yesterday's advance. Investors hoping Fed Chair Powell can fight elevated inflation without derailing economic growth. Take a listen.
He did a really great job of addressing that, highlighting his awareness of it, his willingness to act, but yet in kind of a tone that we're not going to do anything rash.
The Fed doesn't look to surprise.
The Fed is, quite a bit closer to actually lifting off.
Markets were not surprised in a negative way, and so what you're left with is, yeah, maybe they'll do a little bit, but they're not going to do so much to knock the supportive Fed off of supporting financial markets.
We're not going to pull the liquidity too early. We're not going to do anything that's going to disrupt this.
There's still quite a bit of work for the Federal Reserve to do to actually exert tighter financial conditions to slow down the economy.
If we're questioning of whether the Fed was going to announce that they're going to take the punch bowl away, the answer today was no.
That seems to be continuing today. For more, let's bring in Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike.
Well, Lisa, what we seem to be seeing around the world is a battle between inflation mandates at central banks and COVID. How concerned are you about COVID slowing down the economy, and how much can you get away with in terms of your mandates? We see the United States with the blue line there is the COVID 5-day case rate, and then the white line you're looking at what we're seeing in terms of inflation. And so right now, inflation's winning, and the Fed is saying we're going to do something about that, but we still want to bring unemployment down, so we're going to tell you we're going to do something, but we're not going to do something for a couple of months. Now, that's different from what we're seeing from other central banks around the world. The ECB phasing out PEP, inflation's a problem there, but they have a real problem with COVID all over Europe, so they're going to try to wait through 2022. Taiwan is raising rates. They've done a good job of controlling the disease. We're also seeing the Norges Bank raise rates. They also have less of a problem. Mexico expected to announce another rate increase because they have a big problem with inflation. And the Bank of England, of course, today raises rates because they have a big problem with inflation. They also have a big problem with COVID, but the bank says our mandate is inflation, so we have to deal with that. We can't deal with the COVID side.
Michael McKee, thank you so much. Alessio DeLongis of Invesco, ST still with us. Alessio, you were talking about how the market is satisfied with the idea that the Fed has its hands on the wheel and is doing something about inflation. And yet I'm struck by the easy money policies, at least as inferred by the market. Yields went lower, stocks went higher. If anything, monetary conditions, financial conditions loosened. Does this make it more difficult, to Bill Dudley's point, for the Federal Reserve to communicate its message, since this will not do anything to curb inflation if everything remains just easier and easier?
Well, the issue there, it's a very good point, because the issue there is really understanding what is driving that inflation higher. And that is still a difficult debate. We're not talking about cyclical forces. We're talking about the long term. I think one concern that we have is when you look at credit growth in the U.S. or in the Eurozone is still very weak. Annual rates of growth in the corporate sector are really in the low single-digit rates. So as the economy in 2022 and 2023 starts moving from a fiscal push to a transition into private demand, credit growth is really where we have that look into the future to understand whether we run the risk of higher inflation or not. In my opinion, once the cyclical forces are out of the way, that low credit growth number and the flattening of the yield curve, remember, we are, in terms of flattening of the yield curve, we are at the levels where we were in Q4 of 2019, just before COVID. So it's almost arguing that we are well on our way to renormalize out of the pandemic and to return to the low growth, low inflation world that we have had post-GFC.
Let's get a sense of what we're seeing from Esti. Esti, your sense of whether the market is perhaps underestimating inflation, or whether people are just convinced that the Fed has its handle on it, even if conditions, financial conditions remain ultra loose.
So in the last few weeks, we've seen a little bit of a tightening, and now the market's saying, inflation is transitory. We dropped the word, but it does look like, and the Fed still believes it's transitory, even if it hasn't used the word. I think President Lagarde was saying a lot of the same thing with or without the word as well. I think some of this is also confidence in the central banks to say they are dealing with it. They're not going to be overly aggressive and kill off this recovery. There are challenges from the different variants, that COVID isn't quite going away. And so they're not going to basically forget growth entirely. So the view that if growth can continue, earnings can continue, then from a market perspective, the fundamentals are okay. And inflation at some point is, in a way, it appears at the moment, almost its own worst enemy, that prices got high enough that it starts to cool off demand, that demand is going to move from goods to services, that credit can be taken over by banks instead of the central bank. So this balance of inflation is likely to abate in the first half of the year. And at the same time, the credit situation, the liquidity situation is going to be supported not just by the Fed, but generally by the banking sector.
So fascinating. Basically, markets are buying the transitory story, even as the Federal Reserve backs away from it. Coming up, the spread of the Omicron variant showing a few signs of slowing.
In the U.S., we're only now at about 62% of total population vaccinated. That's not enough to hold this off.
More on that conversation still ahead. Meanwhile, markets, you're seeing everything at record highs. Certainly the S&P climbing, even with the hawkish tilt that we heard from Fed Chair Jay Powell. This is Bloomberg.
What we're seeing, of course, is a winter surge that had been predicted. This is still with Delta, but the infection curves for Omicron, and I've seen the data for the UK, for Germany, and for the US, look even steeper than we saw in South Africa. So Omicron is spreading very rapidly.
Omicron cases surging around the world, with the United Kingdom posted record numbers of COVID cases since the pandemic began. Let's bring in Kaylee Lyons for more. Kaylee?
Well, Lisa, the record number of cases is leading the government to encourage people to work from home in the UK, also putting in so-called COVID passes for certain venues. Plus, if you're traveling from the UK to France, you now face tougher restrictions, including self-isolation upon arrival. Plus, all non-essential tourist and business travel will be barred. Here in New York, there's an indoor mask mandate for all businesses that don't require proof of vaccination, and a vaccine mandate for the private sector that goes into effect December 27th, with a $1,000 fine for businesses that don't comply. Broadly, though, the U.S. remains less restrictive than places in Europe where cases are climbing, including the UK, Italy, and Germany. In Austria, we saw that super sharp increase in cases that has now come down due to more restrictive measures. We know, though, that more restrictions have an adverse effect on economic growth. We saw that in the data out of Europe today, including Germany's services PMI, which fell into contraction territory. Lisa.
Thank you so much, Kaylee Lyons. The big question for a lot of people is, are markets underestimating the threat of Omicron, and how are central bankers going to handle it? Alessio DeLongis and Esti Dweck back with us. Esti, what's your sense of whether markets are perhaps a bit too sanguine about the risk of a real uptick and more social restrictions?
At the moment, I think there are two aspects. The first is all of the incoming data continues to point towards mild symptoms, which suggest less hospitalizations. Of course, if the number of cases is sky high, even if the percentage of hospitalizations is lower, it could become a problem over the next few months. But the data so far has been relatively encouraging. The other aspect is that there really is a view that the U.S. has very little appetite for much stricter lockdowns or restrictions. They're focusing on vaccine mandates. That's already a bit of a challenge. And as long as the U.S. economy stays open, on and off restrictions in Europe isn't fantastic for the European economy, but I don't think it will impact global investor sentiment.
Although, Alessio, I do wonder whether there's a longer-term impact on growth expectations from the ongoing pandemic and the idea we're not getting out from under this so soon. Even when it moves to an endemic phase, there likely will be some ramifications that will have some sort of drag. How do you factor that in as you try to figure out your portfolio arrangements?
Well, at the moment, the downside risks of Omicron are actually consistent with our main positioning that is not informed on that, but rather on the just natural cyclical expectation that growth is going to decelerate over the next couple of years, and so is inflation. So investors can maintain a strong risk appetite stance in the portfolio. I think there is still a strong case to be overweight equities over fixed income, but within that equity exposure, restructuring that risk exposure towards more defensive sectors and defensive factors, so more into quality and defensive sectors rather than value-oriented or small and mid-cap oriented sectors. So that is one way in which you can position the portfolio for the next phase in the cycle, and in case those downside risks were to really materialize, that type of positioning is also poised to do well in order to deliver more downside protection if that core baseline view were to suffer from downside risks. And in addition to that, as per the conversation we had earlier, the uncertainty of Omicron really leads to potentially a higher savings rate, more defensiveness also among economic agents, which argues for the long end of the curve to remain well anchored and therefore probably increasing duration in the portfolio, which may be counterintuitive given that we're going into a tightening cycle, may still be a good strategy.
Alessio DeLongis, Esti Dweck, both of you, thank you so much. Happy holidays. The year may be ending, but my goodness, it feels like a lot is happening in the last couple of weeks. President Biden backing a voting rights push as his economic plan stalls in the Senate. The president saying, quote, if we can get the congressional voting rights done, we should do it. There's nothing domestically more important than voting rights. It's the single biggest issue. But House progressives lashing out at the Build Back Better delay. Representative Cori Bush writing, quote, it is unacceptable that discussion of further delays to the passage of the Build Back Better Act is being framed as a choice between this legislation and voting rights. Bloomberg's Mario Parker joins us from D.C. for more. Is the story getting confused down in D.C. with so many disparate strains competing for attention?
Yeah, Lisa. Well, what's happening is you're going to see some more. This Senator Manchin's opposition to Build Back Better just kicked off a fresh internal fight between Democrats again. Democrats immediately tried to pivot to voting rights, and you saw the progressive wing of the party, which has been agitating against Manchin's more centrist wing of the party, saying that it shouldn't be a case where BBB is up against voting rights. Not only did Cori Bush come out, but also Pramila Jayapal also came out as well, saying that it shouldn't be a choice between those two pieces of legislation. Again, voting rights has been on the table. It's an issue for the base, but the likelihood of that passage is even, looking grim right now.
Yeah, well, we don't have a lot of daylight left before the end of the year. Mario Parker, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our trading diary from New York City. This is Bloomberg.
Tqqq.com. Read carefully.
This is Bloomberg Markets, the open with the S&P at record highs, up nearly 1/4 percentage point. Interestingly, the Nasdaq softer just a touch, and the Russell really leading the index higher as we have a more hawkish Federal Reserve, perhaps some sort of stasis at the ECB. Time now for the trading diary, what you need to be watching this week and into next week. President Biden meeting with his COVID-19 response team on the Omicron variant at 3 p.m. Eastern, and Fed Governor Chris Waller speaking on Friday to round out the week. A host of U.S. data coming next week, starting with U.S. GDP on Wednesday. Then we'll get personal income and spending data on Thursday, plus another round of initial jobless claims and the University of Michigan Consumer Sentiment Survey. That was Countdown to the Open. As we draw to a close on this eventful week, this is Bloomberg.
our family, all of our friends. It's just a great experience.
We are not a discount brokerage. These are top local agents that'll get you the best results.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, December 16th. Here are the top market stories that we're following for you at this hour. Public enemy number one is inflation. Bank of England hikes rates. The Fed tries to engineer a soft landing. The ECB sends its emergency bond buying program to an end. Are central banks now behind the curve? Animal spirits try to hang on. Equities stick with gains. Tech a little softer, though. Yields move lower as the buy-the-dip trade for the most part now stays on track. And Harold Hamm's $25 million gift. The oil legend and his company Continental Resources give a combined $50 million to the University of Oklahoma to start the Hamm Institute for American Technology. We speak to Harold Hamm and CEO Bill Berry. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. It's interesting to see equities roll over a little bit as we sort of had some optimism after the Fed, but that BOE rate decision, I mean, what is the communication there?
Well, the communication strategy clearly is broken at the BOE. Why couldn't they have gone in November? Why are they going in December when Omicron has already started to pick up? They see Omicron as being inflationary. So that's what I don't understand here. They told us, they guided us, they made it clear to us that a rate hike was available and was on the cards back in November. They didn't do it. The language changed. It became more dovish. Now we get a surprise in the form of a 15 basis point hike. The expectation is we get 25 in February. Alex, it's just a communications blunder. The message, if you take away November and we kind of ignore November, then the message has been consistent, but it's just been so volatile. Others may be doing a better job of it.
Yeah, and of course, it's all about those price pressures and that sort of moving the hands for the ECB and the Fed as well. But do they need to do more? Is this going to be enough? Are we still going to stay in some form of accommodation for a while? And I think that's the question the market's trying to manage right now.
You look at the market reaction. Yesterday, certainly with the tech stocks in the United States, the market is really super comfortable with where the Fed is right now. The danger is, therefore, that actually this is a dovish message, that as a result, we may need to hit the brakes harder further down the road. And that takes us to our question, really, of the day. Is the Fed, is the ECB, is the Bank of England even still behind the curve? Here's what some of the central bank chiefs have been saying today. Christine Lagarde, Jay Powell.
Under the present circumstances, as I have said before, it is very unlikely that we will raise interest rates in the year 2022. That still stands.
We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support.
Michael Kushmer, Morgan Stanley Investment Management CIO of Global Fixed Income, joining us now to kick this around. Mike McKee also joining us, Bloomberg International Economics and Policy Correspondent. Mike, to his friends. Mike McKee, let me start with you. Let's try and answer this question. The market reaction to the Fed implies that the Fed is still, on balance, still dovish relative to expectations, relative to where we are in this cycle, relative to the inflation narrative that we're talking about. Is the market reaction, does the market reaction tell us, therefore, that the Fed is still behind the curve?
Well, that's going to depend on your view of inflation. And obviously, there is a camp that says inflation is going to stay high, maybe even accelerate, and that puts the Fed behind the curve because it takes a while for policy to get into the economy. Others buy the Jay Powell line that we are going to see inflation fade as energy prices come down and as the reopening problems that we've had start to fade into 2022. And so the Fed will be able to raise rates at a fast enough pace to stay on track.
That's like the perfect scenario, Michael Kushma. I mean, basically you're looking at a growth that holds up while the Fed's able to tampen down inflation. That's like me winning the lottery. Do you think that the Fed can actually do that, Michael Kushma?
It's possible because we've had a combination of supply and demand shocks, and it's no doubt that the U.S. has had the largest inflation surprise of the industrial world in 2021. Part of that is supply side, part of it is demand side. And the demand side is coming from the extraordinary fiscal support and monetary policy support the U.S. has gotten. So the Fed is working with two factors, the supply side, which is global, that's impacting everyone. But the U.S. has had an outsized inflation shock because aggregate demand has been so strong because of all the monetary and fiscal policy support. So there's no doubt that the U.S. no longer needs policy support to have a economy growing at trend or slightly above trend.
Michael, is risk on the right response to yesterday's news from the Fed? That was the initial knee-jerk response. We're seeing it tamp down a little bit today. But is that the right response? Risk on, we get back into tech stocks, we push forward, that is the narrative. Is that correct?
I think it's correct from the point of view that the Fed is still moving cautiously. They still emphasize downside risk from the pandemic or the Omicron virus, as well as unwinding the supply side of things. So a lot of the inflation outlook is still very uncertain. If you recall, just a few months ago, the Fed was saying we have to wait until the second half of next year to really understand the combination of supply and demand. Now, clearly, in the last couple of months, the demand side issues and wage growth issues have come to the fore. But the point is that the Fed is moving slowly enough to keep financial conditions easy. There's no sense of financial conditions tightening meaningfully since they made their pivot in June, and that augurs well for risk down the road, unless inflation does not get better and the Fed has to hit the brakes even harder.
Michael, it's Mike McKee. There are a lot of if-then statements going around about these central banks. But I'm kind of wondering about the topic that Guy and Alex brought up at the top of the show, and that's the Bank of England and their communications strategy. Given that Madame Lagarde and Chairman Powell have laid out a course for the Fed and the ECB, is it harder to invest in England not knowing what direction they're going to go at their next meetings?
They've got a complicated situation because they have an economy still below potential. So they had a much larger hit from the pandemic than the U.S. had and even the ECB had. So they've got a bigger output gap. On the other hand, they've got a Brexit situation, a bigger supply side issues in terms of energy prices, the labor market being much more just in disarray to some degree post-Brexit. They've got a harder situation to manage. Inflation there has been almost the biggest shock to their market as the U.S. has had in here. So that I think they're doing the right thing, focusing on the labor market, but the timing of things has been a bit complicated. It seems that the communication earlier in the year, the last couple of months, the leadership wanted to raise rates, didn't have the MPC on board, and they've gotten the MPC on board. It was an 8-1 vote today, so there's clearly a strong consensus to do what they did. And they're clearly focusing on medium-term issues and expect Omicron not to be a big deal.
That was a really diplomatic way of putting it. Well, just to move then broadly to BOE, ECB, and the Fed, I'm just very confused as to the bond market reaction, because you look at the actual statements and you can make an argument for central bank divergence, a more hawkish Fed and BOE versus a more dovish ECB. That's not what the bond market is telling me today.
Yes, the Fed is tightening faster at the margin than expected. They're bringing 3 rate hikes next year instead of 2 down the road. This is good longer term in the sense that being more aggressive now means less aggressive in the future. That is the $64,000 question. Is there an idea of where the terminal rate is appropriate? They're still talking about raising rates in 2.1%, somewhere in that neighborhood in 2024. That still seems awfully low. But if that's the narrative, the market is suggesting that we're not going to barely get there because this increase in interest rates is going to cause weakening economy down the road. And remember, when most of the Fed rate hikes occur next year in 2023, the economy will be on a downward economic growth trajectory. It will be on a downward inflation trajectory of unknown amounts.
Michael McKee, let me bring in that point, because I think it's a really useful one that Michael Cushman's just raised about the sort of economic trajectory we could be on by kind of 2023. The ECB is pushing back on the idea, Christine Lagarde did it today once again, that the ECB could be raising rates in 2022. Now, the market's got 8 basis points priced for the back end of next year. I think if we get to 10, you could say maybe the market is pricing in a rate hike. But at the moment, she's saying it's 2023. Could the ECB be raising rates when the Bank of England is done, when the Fed is potentially done raising rates, and they're both seeing their economies maybe starting to ease up a little bit? Is that the point at which the ECB really wants to start raising rates?
Well, you can see them doing it. It gives them a currency advantage probably in terms of trade, but it's probably based more on what the economic outlook is for the Eurozone. They're arguing that inflation is going to come down by 2024 to 2.1%, just above their target. And so presumably in 2023, it would also be falling, which would give them the ability to start raising rates. None of the central banks think where they are is normal or useful over the long run. If you don't have a growth problem, you don't need to stimulate the economy as much as they're doing. And they're hopeful, given their forecast, that by 2023, they will be seeing growth up and inflation down. And therefore, you don't need negative rates anymore, market distorting as they are, and they'd like to get out of that. Doesn't mean how high they're going to go, but it does mean that they would probably be looking to move around that.
All right, guys, thanks a lot. Really great conversation. We're going to continue asking this question throughout the next couple hours. Michael Cushma, Morgan Stanley Investment Management CIO, Global Fixed Income, and Bloomberg's Michael McKee. Guys, thanks very much. Some breaking news for you here. Citi is now telling New York and New Jersey employees to work from home for the holidays as Omicron patients and cases here spike. Feel like I've been saying it. Are we 4 to 6 weeks behind the UK and what this means for the holidays? You have a non-lockdown, lockdown feel emerging a little bit. We'll break that down also throughout the next couple hours and what the growth impact and inflationary impact will be on that. Well, coming up, we'll dig deeper. Is the Fed behind the curve? Do you buy risk? Risk rolling over a little bit. Tech now off by about 0.8% as yields really move lower as you get a nice bid into the bond market. Anastasia Amoroso, iCapital Network Chief Investment Strategist, joins us next. This is Bloomberg.
is oxygen.
Let's get back to that question of the day. Are central banks behind the curve? And what do you do with risk assets? Do you buy risk? Here's more insight. Anastasia Amoroso, iCapital Network Chief Investment Strategist. The answer to that question was resounding yes. Now we're rolling over a little bit, tech off by about 0.8%. Anastasia, do you buy risk on the Fed?
I think you do. I definitely would not buy into the moves that we have so far this morning. And I think yesterday was more representative of what I would expect. I think all that happened yesterday is the Fed just marked its own expectations to market, but they did not really deliver any sort of hawkish surprise. For example, the markets were already calling for 2.5 or 3 rate hikes in 2022. Now that's penciled in for the Fed. And the markets were already anticipating a faster taper, and that's what the Fed said as well. So no hawkish surprise. But Alex, one chart that really catches my attention, and I'm sure investors are thinking about, if you look at the level of Fed funds rate today and you subtract out, let's say, the core CPI inflation, that ratio today is deeply in negative territory. It's over -4%. So we're well below zero on real interest rates. And guess what? Even if the Fed does deliver 3 rate hikes next year and 3 more after that, we're still going to be looking at real rates that are below zero for the foreseeable future. So I think you put that together, and that's why the markets have reacted positively. Yep. And so, yes, I would buy what you can on the dip here, which at this point is mostly software.
Anastasia, does that therefore confirm that the Fed is behind the curve and that the risk of a policy mistake, i.e. having to hit the brakes harder later, has grown?
I do think there is that risk. I do think they were behind the curve, and that's why you saw in the press conference, Powell was very quick to pivot. I think there was that realization as he detailed CPI after CPI print and employment numbers and so forth. So I do think that they've been trying to catch up. I think they probably are caught up for the time being, but as any central bank would argue, is they'll say we do have the tools to control inflation if we have to. So there is that risk. But at the same time, if you look at our estimates, consensus estimates, most people do expect inflation to come down throughout the course of 2022. And no, it's not going to be 1.5%. It's probably not even going to be 2. It's going to be above 2%. But we should see, for example, some easing pressure from gasoline prices and commodity prices and used cars. So I do think the Fed is going to have a little bit more wiggle room on inflation next year.
So you mentioned what to buy, right? I mean, today we're seeing cyclicals get a nice bid. You're getting energy and materials, etc. You mentioned software. What do you want to buy when you have a deeply negative real rate and when you have a Fed that's going to stay accommodative to in some respects for the next few years on some basis?
Yeah, I think software is really interesting to me, Alex, because if you look at the tech sector, you've had this resurgence in semiconductors, and of course I like that. But software, it tends to be a longer duration equity, so it would get hit when you have rates that are rising. But if I look at the software multiples, for example, EV to EBITDA, they have already corrected to the tune of 20-23%, which is in line with the average multiple correction that we have seen. Said another way, software is essentially pricing in 100 basis points of rate increases. And this is what's making it more viable to me at this point, because the potential for rate hikes seems to also be baked into these software multiples. So, but at the same time, if I look at the environment for tech spending, a lot of that is going to go to enterprise software once again next year. If tech spending this year grew 10%, it's going to slow down to 5%. But if you look at the enterprise software vertical, that's still likely to grow at 11% next year. So I think there's a lot to do in this space. And I would further point out cybersecurity. You also heard Jay Powell mention yesterday, one of the top risks that he thinks about is the potential for cybersecurity breaches. Well, if you look through the cybersecurity vertical, that is the fastest growth rate of spending. So I would be looking to buy some of those cybersecurity names on the pullback.
In terms of how once we get into rate hikes, Anastasia, what does history tell us about how stocks perform? Once we start getting into a hiking cycle, as you look back cycle after cycle after cycle, at what point do stocks actually react to that cycle?
Yeah, Guy, if you look at history, it's not that bad for stocks when the Fed actually starts moving interest rates. In fact, we looked at the last 4 rate hiking cycles. In all of them, from the time of the first rate hike to the time of the last one, the stocks returned. They had positive returns. And what's interesting, too, is that the NASDAQ actually outperformed the S&P in 3 out of those 4 rate hiking cycles. So the big story here is that even if the Fed starts moving rates higher, they're likely to slow down the equity returns, but they're not going to derail them altogether. And I think that happens for a couple of reasons. First of all, the reason for slower returns is you're not going to get the kicker from multiple expansion. We looked at multiples over the last four cycles, and you see most of them compress a little bit or stay range-bound as the Fed hikes rates. So you're not going to get that extra kicker. But all of these companies are still likely to deliver robust earnings growth because, as Powell characterized the economy, this is a really strong economy. So that should deliver really strong earnings growth. And so long as that's the case, that's what should support stocks here. So somewhat lower returns, I think, for the S&P, for NASDAQ, but I certainly still think it's likely to be positive.
Anastasia, thank you very much indeed. If we don't see you before the holidays, thank you very much indeed for joining us this year. Anastasia Amoroso, iCapital Network's Chief Investment Strategist. What we got coming up for you? Reddit's the home of Wall Street Beats, Wall Street Bets even, if I can read correctly, confidentially filing to go public. More on that story next. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Justin Morton. The former CEO of McDonald's will return $105 million in cash and stock awards to settle a lawsuit by the fast food chain. Steve Easterbrook was fired over his sexual relationships with subordinates. McDonald's says the amount represents what Easterbrook would have given up had he been forthcoming about his actions and been fired for cause. Delta Airlines is reversing an earlier outlook. It now says it expects to report a profit in the fourth quarter due to strong demand for holiday travel and lower fuel prices. In a filing today, Delta said revenue has recovered to 74% of its level in 2019. The U.S. is stepping up action against China over its biometric surveillance of Muslim Uyghurs. The Commerce Department is adding China's Academy of Military Medical Sciences to the banned entity list. A senior administration official says China has a history of exploiting DNA collection and facial recognition evolving Uyghurs. The U.S. says that it has led mass detention and persecution. And that's your Business Flash.
Great stuff. Thank you very much indeed. Reddit's the go-to destination for day traders, and the meme stock frenzy filing for an IPO. Confidentially, the S1 is in. Kriti Gupta here with the details. Kriti.
Yeah, Guy, thank you. A $10 billion valuation on one of the forums actually led to some of the volatility that we saw earlier this year. It wasn't too long ago where you actually saw the likes of AMC, GameStop actually shake the markets altogether. And that's really what I want to talk about here. Essentially, Reddit's IPO coming down, and this coming after they reached 50 million daily users in February alone. So once again, not only since that kind of market volatility event earlier this year, but those daily users have continued to climb. But let's just talk about IPOs broadly, because we actually just got another headline that TPG is now filing for an IPO as well, applying to list the stock on the NASDAQ. But if you actually look at how those recent IPOs are performing compared to the S&P 500, they haven't been performing very well, and those actually used to be all the rage when it comes to the market bid earlier this year. And a reason for why they might be actually coming to the market instead, the likes of Bumble, for example, or Rivian, they are actually potentially getting ahead of the market, ahead of potential rate hikes. And that's going to be a key piece of the equation as we go into 2022. We heard yesterday the Federal Reserve pricing in 3 hikes on the dot plot, looking at as many as 3 hikes next year. So how that impacts the IPO space, specifically a ticker like this, the meme ticker, that actually tracks some of those names from earlier this year, how that performs, that'll be the key question.
Yeah, Kriti, and I also think it's interesting as well, if we look out the next couple years and we do see a still continued dovish Fed in some respects, it's going to be hard to not keep buying the dip. And I feel like the SPACs, the IPO, the meme names, like all of that is part of it.
Right, and we're talking about here accessing, getting those funds from the equity market. We have to talk about the debt market as well, because as you start to see some of those borrowing costs increase, will that easy money be as easy, Alex?
All right, Kriti, thanks a lot. Really appreciate it. Kriti Gupta joining us there. All right, coming up, it's a $50 million investment in the future of U.S. energy. Harold Hamm, Continental Resources founder and chairman, and CEO Bill Berry are up next. They're giving a combined $50 million to build a museum and promote education for the future of energy leaders. We'll break down why now and what it says about the environment. This is Bloomberg.
All around the world, tech companies are innovating and driving returns for investors. At Our Crowd, we analyze companies across the global private market, selecting those with the greatest growth potential, then bring them to you. From personalized medicine, to cybersecurity, to robotics, quantum computing, and more. Our Crowd's accredited investors have already invested over $1 billion in growing tech companies. Join the fastest growing venture capital investment community at ourcrowd.com.
In China, we're probably looking at a temporary slowdown, which is mostly motivated by reduced mobility from region to region.
All right, we're 1 hour into the U.S. trading session. We're kind of rolling over a bit, particularly when it comes to tech. Bloomberg's Abigail Doolittle is looking at all the movers for us. Hey, Abigail.
Hey, Alex. Well, it's pretty interesting because, of course, yesterday we had that big Fed-induced rally after the meeting, and typically, often, we will see a reversal of that. So we are having a reversal for tech in particular. The S&P 500 had flipped negative, right now up just a little bit. So investors still uncertain about what's next and whether or not the Fed was actually hawkish enough. And, of course, the ECB, there's some thought that I heard from you, Guy, actually, that they were not as hawkish as folks had hoped. I believe that's what you said earlier on the open. In any case, take a look at the S&P 500 up slightly. The NASDAQ 100 now down 0.7%, probably down on the week. Apple, the big weight here on both of these indexes, down 2%. And then bonds yesterday falling, slipping a little bit flat after the FOMC meeting. Now we have a bit of a rally as yields are lower. However, if we go into the Bloomberg terminal, we are going to see that the trend for yields is higher, that the uptrend really holds in a nice way. It is up and away for that 10-year yield going higher here. And you can see this is over the last year. It's a very simple trend line, not very sophisticated, but sometimes simple is best. And you can see that there is a backup in yields. It hasn't been a straight line, but it typically does not happen in a straight line. And then finally, one reason to think that maybe stocks can close to the upside, we do have another pocket of risk assets climbing on the day. We have the Bloomberg Commodity Index up 1.5%, a very nice rally there as the dollar falls. We also have oil and natural gas higher, and take a look at that S&P 500 energy sector, one of the best, up 1.8%. So there's a real bright spot on the day, energy.
Yeah, very much so, Abigail. We just had a really nice draw there also in the natural gas storage report for the week. All right, let's talk more about oil. So the future of American energy just got a $50 million boost from Harold Hamm Foundation and Continental Resources to build the Hamm Institute for American Energy at Oklahoma State University. It will play home to the Oklahoma Hall of Legends Museum, host symposiums and summits, and be a state-of-the-art classroom for students at the university. The goal is to educate the next wave of energy leaders. And we welcome now Harold Hamm, Continental Resources founder and chairman, and Bill Berry, Continental Resources CEO. Guys, thank you so much. Good to see you. It's been quite a long time. Thank you so much for joining us. Looks like, I hope our sound is all right. Let me ask the first question and see. So Harold, I just want to start with you. I've known you for quite a long time. You've been very active in the community. Why did you decide to make this kind of investment now?
Well, I think it's